Catching market tops and bottoms is challenging, yet they are the most profitable. So what's the next alternative? Well, it's catching the first pullback after the market has topped or bottomed. Now imagine if you could enter just when the market has bottomed and get in somewhere here. That's a pretty solid trade, isn't it? Well, that's the advantage of trading the first pullback. The first pullback will allow you to enter near the top or bottom and get in just when a new trend is about to start. So in this video, I'm going to show you how you can catch the first pullback so that you can ride a new trend and capture high reward to risk trades. I will provide a step-by-step guide to help you capture this first pullback. Now, if you follow the steps diligently and watch this video till the end, I promise that the 15 minutes or so you invest in watching this video will translate to a positive ROI. Sounds good? Please hit that thumbs up button, subscribe to the channel and turn on the notification bell. We do a giveaway worth $37 for every single video that we release. So if you want to win our plug and play trading package, look for an emoji somewhere in this video and comment on what the emoji is. The full instructions can also be found in the pinned comments section down below. Now earlier on, I explained that the most lucrative way to trade is to pick market tops and bottoms. But it's challenging. So catching a pullback after the market has topped or bottomed is a better alternative, as it allows us to enter near the top or bottom and still capture a big chunk of the trend. It's also low risk because you will have waited for the turn in the market. And coupled with a very attractive reward to risk ratio, you can afford to be wrong even half the time and still make money. So, how do you identify them, and more importantly, how do you trade? I will cover this next, so keep watching. But here's a summary of the steps involved. Step number 1, identify a change in trend by observing the highs and lows. Step number 2, identify trendline and market structure confluence. And step number 3, enter using a price action candlestick pattern or the ABCD pattern. Don't worry if any of this sounds confusing, because as always, I'm going to walk you through each of the steps of the process and show you examples. So let's jump into step 1, which is to identify a change in trend by observing the highs and lows. So in this chart, we can see that price has been forming a series of higher highs and higher lows. So that's an uptrend. But watch what happens next. Instead of carrying on this pattern of higher highs and higher lows, price breaks the higher low and makes a lower low. This is the first sign of a change in trend. Every bearish trend reversal starts with a lower low, followed by a lower high, and ultimately into a lower low. This is otherwise known as the ABCD pattern, something that I will cover shortly, so keep watching. Now let me show you the bullish trend reversal scenario just so that you are very clear about this step. So over here, you see that price has been forming a series of lower highs and lower lows. That's a bearish trend. And rather than resuming this pattern, price breaks the lower high to form a higher high. When we see this, it's time to move to step 2, which is to identify trendline and market confluence. Now this step is very important, and I can't stress this enough. There are many traders out there who try to catch the first pullback whenever the price breaks the higher low or lower high, and they lose money because they miss out on this step. So rewatch this portion if you must, but please don't forget to perform this step. Now generally at the market tops or bottoms, you will see two kinds of chart patterns: the double top or bottom, the head and shoulder, or the inverted head and shoulder. So here are some examples of what I mean by identifying trendline and market structure confluence. You can see that it is possible to combine trendline and market structure to get the best entry in each of the patterns. Now, what I showed you are the ideal setups, but as you should already know, trading isn't always black or white, and the perfect setup doesn't always happen. Sometimes you will get setups where there is market structure but there isn't a trend line, and other times you have a trend line but there isn't market structure. So in an ideal situation, having both would increase the probability of the trade working out, but you can still go ahead to take the trade as long as one of them is present. Let me show you two examples before moving into the last step. In this chart here, we have price making a series of lower lows and lower highs. Price eventually makes a higher high and we see a nice inverted head and shoulders pattern over here. We draw the descending trend line like this and we see that the trend line was broken. This broken trend line coincides with the left shoulder. So we wait patiently for price to pull back to the level before taking a trade, which I will cover in step 3. Oh, by the way, a quick tip, if you struggle to identify where to connect a trend line, simply switch over to the line chart and you will be able to see it clearly. So here's another example, this time a bearish reversal. We can see that price is making a series of higher highs and higher lows initially. And then price makes a lower low, forming a double top pattern. This time, price pulls back to the neckline of the double top pattern. In this setup, we have a trend line and market structure confluence. The trend line comes from the double top pattern's broken neckline, and the market structure comes from the double top pattern itself. So again, I can't cover every single possible trade setup in this short video, but remember that you need to look for a confluence of either a trend line or market structure, or in the ideal case, both trend line and market structure. So let's move on to the final step, step 3, which is to use a price action candlestick pattern or the ABCD pattern as an entry trigger. This is how you enter the trade and put everything together, so keep watching. Let me return to the first example in step 2 because it will be easier to illustrate this step without repeating the entire process. So here, price pulls back to the broken trend line and the left shoulders level. So how do we enter? Well, we can wait for a bullish price action candlestick pattern like the bullish engulfing pattern and the piercing pattern. This is an earlier entry and also a more risky entry. But the key advantage is that you get in earlier with a tighter stop loss. Now, if you prefer a more conservative approach, you can use the ABCD pattern. You enter when price makes a higher high. In this case, you can see that the stop loss is way wider and you're entering late. But that's the trade-off that you make if you want a more conservative entry. Moving on to the second example covered in step 2, price pulls back to the neckline of the double top pattern. Again, the aggressive entry would be to enter upon seeing a bearish price action candlestick pattern at the trend line and market structure confluence. And the more conservative ABCD entry would look something like this. You will sell when the price breaks the low as denoted by the swing low point B. In this case, because the engulfing pattern is so big and breaks below swing point B at the same time, the entry trigger is the same for both conservative and aggressive entry. And that's the entire strategy. This strategy will allow you to catch the first pullback of a new trend. It's much safer compared to picking market tops and bottoms. Now with these setups, you want to be patient. Be patient in riding your winners. Why? Because if you got in at the start of a new trend, your profit potential would be the greatest. So be patient because this isn't a momentum play where you ride the short-term momentum and exit when momentum fades. Rather, you want to be patient and look to capture as much of the trend as possible. I won't cover how you can maximize your profits in this video because that's a separate video on its own. But if you are keen to learn how you can maximize your profits, then I will leave a link to one of the videos that I've previously created at the top right of this video. So here's a quick summary of the entire strategy again. Step 1. Identify a change in trend by observing the highs and lows. Step 2. Identify trendline and market structure confluence. And step 3. Enter using a price action candlestick pattern or the ABCD pattern. And that's it for this video. I hope you got value. I will leave the video on using exit indicators to maximize your profits in the end screen over here. Thanks for watching. I'll see you in the next one.